Hey guys, welcome to another episode of Thinking Like a Bank, where we show you how to think like a bank using the same strategies and principles that banks use to help you find more financial freedom in your life. I'm your host, CRE Ibrahim. With us today, we have a repeat guest, an awesome guest. His name is Dan Lewkowicz. He was on episode 20 of this show. So check out that show to learn more about Dan's background and how he got into commercial real estate and what he's doing. So welcome back, Dan.
Thank you very much for having me. I appreciate it.
Thanks. So Dan, I want to talk about lending more from the perspective of the broker or the investor on this episode. Last episode, we talked about, different types of commercial real estate, how to find them, how to evaluate them. But this episode, I want to talk more about lending. So let's say, for example, you and I both find a property and we're ready to proceed to the next step. So what are the next steps?
So if you've isolated an asset that you want to consider purchasing, the first thing that you're going to need to do is submit a letter of intent, right? So you're going to need to come up with some form of negotiation between yourself and the seller, usually in the form of a formal letter of intent, which is typically non-binding. Once you have come up with terms and price that is agreeable to both parties, typically the buyer, but in many cases the seller, will execute a purchase and sale agreement, which will then be reviewed by the lawyers on both sides. And when a suitable form is achieved, at that point, both sides will sign the agreement. Now, at that point, the due diligence period starts, and that's going to be a very important period that's full of a lot of different timelines. So at this point, you would work hand in hand with your broker to open up. Usually the broker is actually going to handle most of these things, but you'd open up title at a title company. You would get in touch with the lender if there is going to be a loan on the deal. Mm-hmm. The lender is going to want to make sure that they're in touch with the broker, that they have all the personal financial statements and tax returns, usually 3 years of tax returns from the potential buyer. And then the broker, the buyer, and the lender will work together throughout the due diligence process to make sure that the lender has all the documents that are needed. I know that the focus of this episode is more from the perspective of borrowing capital, so we'll focus on that. Mm-hmm. So at that point, you're going to order an appraisal of the property. Usually the broker will assist with that. The bank is going to want to have a third party go out there and appraise the property. In addition, there will typically be environmental inspections that will occur, at least a phase 1 environmental. If there are some potential environmental hazards or contaminants, then perhaps a phase 2 will be necessary. So during this period, which typically lasts about 21 to 45 days, depending on the type of asset class and depending on the offer that you make, there's going to be a lot of moving parts. And the bank is going to want to make sure that not only is the lender a strong lender, but the asset is priced properly, and that there aren't any environmental concerns or major structural concerns that would make the asset undesirable from the bank's perspective should they need to repossess the asset.
Okay, that makes sense. So what are the typical down payments? Is it 25% typical?
So typically it depends on the asset, but typically what we're seeing in today's market is down payments anywhere from roughly 30% is a good barometer. Sometimes we can see a 25% down payment. Sometimes, an investor will put down 35%. So typically between 25 and 35%. I've done deals that have 50% leverage. It's really all at the appetite of the investor and the lender. Typically, we don't see down payments less than 20% in our industry, or 25%, I should say.
That makes sense, because typically when you compare commercial real estate to residential, there's more risk involved, right? From the lender's perspective with commercial real estate.
Not necessarily. Commercial real estate, the difference here is if I go into this home, right, that we live in, I'm myself and my wife are the home buyer. We might have bought this with a lot of emotion. We might have made decisions that weren't as calculated as a commercial real estate investor would. Typically, especially with net leased assets that have cash flow and no landlord expenses, the investment is pretty easy to underwrite, believe it or not. And we're typically dealing with large national tenants who they don't make decisions based on emotion, and they are very well capitalized and have a number of locations across the country or maybe even across the world that are guaranteeing this lease. So typically they're not high risk for banks. These are loans that banks love to give. In contradistinction to residential loans, commercial loans are typically refinanced every 5 years.
Okay.
So there's a lot of transactional perks, if you will, for the bank to lend on commercial real estate. And many of these deals are very, very secure. They're main on main corners and major intersections in major cities with major national tenants.
Got it. So is that called asset-based lending? Is that the right term? So they're lending.
Is it called asset-based lending? I mean, typically the loan is You're looking at what's called the DSCR, the debt service coverage ratio, which
Uh-huh.
is a ratio that takes into account what is the relationship between the monthly debt service versus the monthly cash flow. So, typically we want to see a debt service coverage ratio 1.25, 1.5, something like that, maybe even more. So really, the idea here is that if the tenant pays their rent a certain number of months out of the year, you're going to still be guaranteed to get your payments. So they are very secure. In addition, most loans have what's called an ALR in them, an assignment of leases and rents, which is a document that the new owner will sign at closing, which states that in the event that they stop paying the mortgage, the leases and rents are actually assigned to the lender. So the lender can step in and start collecting directly from the tenant.
Okay. Yeah, that sounds like an additional layer of security for the lender that way. Now, let's say, for
Yes,
example,
absolutely.
it's like a property management company that's gonna buy the asset. And would the bank underwrite the property management company as an entity as well as the owners individually, or is it one or the other usually?
Well, so let's just make sure we have this straight. So the asset is owned by one individual in this example?
Yeah, and the asset is it's going to be owned. The person interested is actually an entity. It's an LLC that's
Sure.
interested.
Okay.
Mhm.
And then there is a property management company that manages the asset.
Yes.
So property management company is really going to have nothing to do with the underwriting of the
Okay.
actual asset. They are actually an expense.
Okay.
So just like the bank understands, especially when you have like a multi-tenant deal, which it sounds like you're talking about,
Yes.
there's going to be expenses. There's going to be things like taxes, insurance, common area maintenance. There's going to be, different utilities or management fees. So that's just going to be underwritten into the deal as an expense. Now, if let's say you had a $2 million shopping center that brought in, I don't know, let's just call it $200,000 of net operating income,
Yes.
right? Let's say maybe there was 300,000 in gross collected rents, $100,000 in expenses. If the bank saw that you had a 1% management fee in there, right? You're only paying the manager $3,000 out of $300,000 in gross collected rents. The bank is going to say, wait a minute, this is somebody cutting corners on their underwriting to try to inflate the value. And they would want to see something that's more in line with the industry standard. But aside from that, the bank really does not care about the property management company.
Okay, got it. Okay, that makes sense. Now, sometimes in residential real estate, I see like private money lenders involved, where like instead of going to a bank, like the
Sure.
investor who wants to buy the property will go to a private money lender. Do you see the same in commercial real estate?
You do, but it's far less common because we're dealing with much higher sums of money and the cap rates are relatively low. So if let's say, for example, I'm looking at a deal that's 7 cap and I can get financing at 3.5%, well, I've got still a 3.5% spread between what I'm borrowing at and what my return is.
Yes.
If I'm going to borrow money at 8 or 9 or 10 or 11% and I'm getting a 7% return, I now have negative cash flow. So it's not really going to make sense. What you do see sometimes, like I'm working on a relatively large deal right now, 49 million. And there's actually going to be a seller holdback, a seller carryback, which is also
Yes.
known as seller financing. So for example, this is a $49 million deal. The bank is going to finance about 32 million, if I'm not mistaken. The seller is going to hold back about $7 million as a second mortgage on the property. So that has allowed the buyer to come to the table with far less cash because they're borrowing the majority from the bank. They're getting, $7 million from the seller, and then they're going to come up with their own few $1,000,000 for the rest of the down payment. And in this case, because it's such a large deal and the lender is this lender that we're using actually already has a loan on the property, and they're partnering with another lender that has done deals for our client, the seller. We're representing both sides, but the seller many times before. So they're actually going to partner together, and we've got a lot of different lenders, and whether they're institutional lenders or the private lender seller stepping in together to really creatively come up with a way to finance this deal.
Got it. And what are the typically right now, what are you seeing interest rates as of January 2022?
Yeah, so this is going to be, whatever I tell you right now is going to be quickly outdated because we're looking at 3 or 4 minimum, interest rate hikes this year.
Yes.
But over the last 90 days, I've seen quotes as low as 2.75%. Now that was a pretty much an outlier because it was a portfolio of 10 Walgreens. They were main locations, top stores in the company. There was no recourse, no personal guarantee on that.
Wow.
Incredible financing offer there. Typically, we're seeing right now more commonly rates in the 3.5, 4, 4.25. Really depends on creditworthiness of the tenant, as well as the financial soundness of the borrower
Mhm.
and the asset, some general aspects of asset strength and market strength, et cetera. But you can look right now somewhere in the mid threes to low fours should be typical. What's also important
Mhm.
is the amortization.
Yeah.
So if we have a deal that's got a 15-year amortization versus a deal with a 30-year amortization, the monthly payment is going to be way higher on the 15-year am.
Yeah.
So
Yes.
for investors, it's very important to get a loan that has a long amortization period. So I tell, for example, we sell a lot of pharmacies, probably more pharmacies than anybody in the country. I tell people, if you're looking at a pharmacy deal from the big three, Rite Aid, Walgreens, CVS, if you stay with the two that are the better tenants in my mind, the Walgreens and the CVS, right now, as long as you have about 7 years left on the lease or more, and you've got good credit and you can handle the payment, you can typically get 63 to 70% loan to value. So only what would that be? The 27,
Mhm.
you'd be looking at under a, so it'd be like a 37% or 30% down payment.
Mhm.
And the amortization is anywhere from 25 to 30 years, which really helps. If you're looking at other buildings like banks, a lot of the major lenders actually require what they call the designation of a special purpose building on banks and credit unions, because they have vaults in their facilities, which are very difficult to remove or repurpose. So they actually will only give a 15-year amortization on a special purpose building. So if you were looking at a Walgreens and you were looking at a bank that it looked exactly the same, your cash on cash return on the bank would be way less than your levered cash on cash return, because it would be a 15-year amortization versus the Walgreens could be a 25 or 30-year am. Make a
Okay.
huge difference in your bottom line.
Well, I didn't even think about that. I didn't even think it was there. I didn't think for some reason, I assumed 30 years wasn't even possible in commercial real estate, but
It
obviously,
is.
yeah. Yeah. And speaking of banks, like, so when you go get these loans, these commercial loans, is it like any bank like Chase or Bank of America or Wells Fargo, or are there specific banks
Good
that?
question.
Mhm.
So a lot of times buyers or sellers have existing relationships with local, community banks. As a brokerage, we have an in-house loan broker who
Mhm.
will work with, hundreds of lenders across the country. It's really all about the fit. I mean, I've got some clients that have long-standing relationships with their banks, and that's
Yeah.
just who they use on every deal. And I have other clients that are constantly asking me to make an introduction. So it really all depends. I mean, as a broker, I have to really determine who the best lender might be.
Yeah.
If it's a deal that is a little bit outside of the box or is special or unique, I probably want to go first with a community lender who knows the asset, right? Who knows the market and believes in it. If it's a more traditional, net lease retail deal that's just cookie cutter, you
Mhm.
can go to pretty much any lender. So it all really depends on the deal.
Got it. Okay. Now, do you do any, like, for example, like I've been interviewing a lot of general partners of syndications on here, and like for those who don't know, syndication, a bunch of people pull their capital together and they'll buy like an $80 million building. Is that something like you guys do, like those types of
Yes.
property? Yeah.
Yep. In fact, we have one open right now. This quarter, we're going to be putting a few investors together into likely a triple net or double net pharmacy deal.
Okay.
So exactly like you're talking about, a syndication where a few people come together, pool some capital, and then we can diversify our risk by buying multiple assets and allowing people to participate in deals that they otherwise would not have been able to participate in.
Mhm. And then double net and triple net, that refers to the expenses, right? Can you
Yeah,
explain
so a
more?
double net deal traditionally will have some landlord responsibilities for things like roof structure or maybe parking lot repair and maintenance, whereas an absolute triple net deal will have absolutely no landlord responsibilities whatsoever. Even if there's an issue with the roof structure, parking lot, that is completely on the tenant.
Got it. Okay. And then from like the landlord's perspective, that's like the best type of deal to get, right? Triple net.
Yeah, I mean, you're going to typically have a lower return in an absolute triple net deal than you will in a double net deal because it's much more passive and less risky.
Mhm.
But many investors, especially institutional investors, prefer the passivity of just getting an ACH or wire transfer every month and not ever having to worry about any maintenance or repair on the building.
Got it. Yeah, this is where like the thinking like a bank comes in, is that like the volume of payments coming in over time is better than greater payments and more risk. In other words, less risk, more payments coming in.
And also, this is
Yeah.
also more certainty because I
Yeah.
know what my monthly payment's going to be. I know that I'm getting my, whatever it's going to be for $25,000 a month or whatever the lease
Yes.
holds for. Whereas if this was something that had landlord expenses, well, what if I need a roof, or what if, there was some unforeseen expense, or what if, I didn't take enough money and put it aside in capital expenditures and now I have to spend 50 grand on something. So with an absolute triple net deal, for the duration of the entire lease, it could be a 20-year lease, exactly what that rental payment is going to be without surprises.
Got it. Okay. That makes sense. Now,
but you know what your net operating income is too. You know what your bottom line is because there is no expense. So whatever your rental payment is, that equals your NOI.
Okay. How is your course going? CRE Pro course.
How's the CRE Pro course?
Yeah.
Yeah, it's great. We've had many new people sign up. We've been doing pretty much weekly LinkedIn live events, just adding value and talking to people about our course. By the way, if anybody wants to find out more about the course, they can go to creprocourse.com. That's CRE, like commercial real estate, procourse.com. We also have a mentorship program that's going really well.
Mm-hmm.
It's really awesome to see our mentees doing deals that they sourced in the mentorship program. In addition, we've got a mastermind that is starting this Friday, actually. And that's a small group of people that are in the CRE Pro course in one shape or another, in one form or another. And we've created a mastermind based on their requests to teach them how to not only broker commercial real estate deals, but also how to source them themselves and to syndicate them. So this mastermind it has a focus primarily on sourcing your own deals, raising capital, and doing syndication deals as a group, which is really fun. So it's been great. I actually made 2 hires last quarter for the Lewkowicz group from graduates of the CRE Pro course.
Nice. Awesome. Okay. And I was thinking, like, is it only for brokers, or could it be like other professionals who want to learn more about commercial real estate, like financial planners?
Absolutely. It's for brokers. It's also for investors who want to learn how to do this themselves. And then we have quite a few lenders, title companies, and other ancillary services. Like we have some inspectors as well. We just wanted to understand commercial real estate from a broker and investor's perspective.
Yes.
And they found tremendous value in the course and in the community aspect as well.
Yeah, definitely. Like as me being a financial planner, I'm thinking it would help me too, like talking to clients, explaining things. Yeah.
In fact, I'm not going to get on your show again unless you take the course.
Yeah, for sure. I'll check it out, Tim. And for those who don't know how to reach you, how can they connect with you and learn more about you?
So you can go to our website. It's theLewkowiczgroup.com. That's my first name is Dan. My last name is Lewkowicz, Lewkowicz. Again, Lewkowicz. You can check out our website. You can reach me on my cell phone, 248-943-2838. Again, 248-943-2838. Also have a website with about 160 episodes of our show at this point, with some other valuable free information. And that's danontop.com, danontop.com. You can shoot me an email too, Dan@danontop. There's tons of ways to get in touch.
Awesome. Okay. I'll be sure to add all this in the show notes. Dan, thank you so much for joining us, and looking forward to having you back on the show. Yeah. Hey, it's my pleasure. Absolutely. To learn more about what we do and how we can help you grow more wealth, please visit www.finassetprotection.com. That's FIN, assetprotection.com. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.